Welcome to the Deep Dive. We're here to help you cut through all that information overload and, well, get straight to the insights you actually need.
That's the goal.
And this week, wow, a lot of people are calling this a truly big week for global markets.
Yeah, it definitely feels that way.
It's shaping up to be a pretty high-stakes environment for investors. And honestly, just the sheer amount of news, it can feel a bit overwhelming.
It absolutely can. So our mission with this deep dive is really to take that pile of complex market analysis, economic reports, all of it, and turn it into clear, actionable insights.
Right.
We want to help you sort of understand the signal from the noise so
Yeah.
you feel well-informed, prepared, regardless of how much experience you have.
Exactly. And the aim is to help you approach any volatility with, well, with confidence. We seem to be heading straight into a predicted surge in market volatility, especially around July 30th. What makes that specific day so significant on a global scale?
What's really striking here is the sheer confluence of major events happening almost simultaneously. On July 30th, you've got the Federal Reserve's key policy decision hitting right alongside a flood of global economic data releases.
Ah, okay. A perfect storm almost.
Kind of. It
Yeah.
creates this genuinely high-stakes environment right across the board. Equities, currencies, even crypto. Any deviation from what's expected could really trigger some sharp market movements. It's a pivotal day for figuring out where the global economy might be heading.
So let's zoom in on the Fed then. The Federal Open Market Committee, the FOMC meeting, led by Chair Jerome Powell. The consensus seems really strong on no rate change, right? Which feels almost anticlimactic given the buildup.
It does seem that way on the surface.
But what's the real tension point here for investors? Is it all just about Powell's language, or are there some hidden anxieties we should be tuned into?
Well, the expectation is overwhelming. Something like 97.3% of interest rate traders think the benchmark rate will hold steady, in that 5.25% to 5.5% range. But the real tension, it lies in Powell's press conference after the meeting. Every single word he says is going to be scrutinized for any hint about future policy shifts.
Okay, so it's all about the forward guidance.
Exactly. Investors are trying to gauge the timing of the next move. For instance, there's this potential for a September rate cut kind of hovering out there. If the incoming inflation and employment data cool off more than expected, that's the tell everyone's going to be listening for.
And speaking of employment data, Friday brings the big one, the July jobs report. Now, beyond just the headline number, how many jobs were added, what are the subtle indicators, the underlying trends in that report that savvy investors should really be watching? What's the signal you're looking for there?
Yeah, that's a crucial distinction. The monthly employment situation summary from the Bureau of Labor Statistics, it's actually a powerful mix of two different surveys. One survey asks businesses, about 121,000 of them, how many jobs they're adding. That gives us non-farm payrolls, average weekly hours, average hourly earnings, the nuts and bolts. May saw about 139,000 jobs added there. The other survey interviews households, 60,000 of them, about their employment status. That's how we get the official unemployment rate, the U3 rate, which was 4.2% in May.
Got it. So two different angles.
Right. And beyond just the number of jobs, like the forecast 102,000 for July after June's 147,000, we really need to pay close attention to average hourly earnings.
Why is that so important?
Because that indicates labor cost pressures, right, which can directly feed into inflation. And the average hours worked, that can actually be a leading indicator for labor demand, signaling shifts in the economic temperature before they show up elsewhere.
Interesting.
And it's probably worth noting, too, that there's this ongoing pressure from the White House on Powell to cut rates. We're just reporting that, not taking a side. But it adds another layer of political sort of nuance to the Fed's decision-making process.
Okay, so we've got the Fed decision, the jobs data, that's setting the macro tone. But another really critical piece of this global puzzle, especially for international trade, is unfolding this week too. The U.S. president's August 1st deadline, self-imposed, for new trade deals.
Yeah, that deadline's been looming.
But despite that threat, market optimism seems surprisingly high. Stocks are near record highs, volatility's been low. What's going on there? Is the market just ignoring it?
Well, what really stands out is that a major piece of that puzzle has actually fallen into place already. Japan and the U.S. struck a deal recently, and now we have this quite detailed framework agreement between the U.S. and the EU, which was unveiled in Scotland.
Right, I saw headlines about that.
And this aims to bring some much-needed certainty to tariff policy. This new EU deal, it's really a masterclass in compromise, trying to find a middle ground.
How so? What are the specifics?
For most e-goods, including tricky ones like automobiles and auto parts, there's going to be a 15% tariff straight across.
Okay, and how does that compare?
Well, it's higher than the 2.5% from last year, but it's lower than some of the really steep numbers that were floated before, like 20% reciprocal tariffs or even 27.5% on autos. So it gives businesses some certainty and avoids, a full-blown trade war escalation.
So a delicate balance then, trying to prioritize stability. What about specific sectors? Are some treated differently?
Yes, definitely. Strategic sectors like pharmaceutical products and semiconductors, they get a temporary 0% tariff.
The zero, okay.
Temporarily, yeah, until some related Section 232 investigations conclude. But the deal ensures those tariffs won't go above 15% later on. Similar terms for things like timber and copper. It signals a kind of strategic push in those areas.
What about steel and aluminum? That was a big flashpoint before.
Right. The U.S.'s 50% tariffs on steel and aluminum, those are expected to stay in place in the near term. But importantly, the two sides agreed to negotiate a quota system.
How would that work?
Exports within the agreed quota would face low standard WTO rates, but anything outside that quota would still face the hefty 50% tariff. So, managing the flow.
Got it. Any areas where tariffs are just gone completely?
Yes, and this is pretty significant. There's a list of goods with 0 for 0 tariffs. Think aircraft, certain chemicals, generic drugs, semiconductor manufacturing equipment, natural resources, critical raw materials.
So basically free trade in those specific goods.
Exactly. But it's important to note what's not on that list. Sensitive agricultural products, beef, rice, ethanol, sugar, poultry, those are notably excluded, still protected.
Okay, that's a lot of intricate detail, but it sounds like overall a pretty significant step forward in U.S.-EU relations, right?
It really is, and the implications go beyond just tariffs.
How so? What are the broader strategic implications here for the global economy?
Well, this deal isn't just about trade duties, it's also about shifting strategic alliances and, importantly, supply chains.
Okay.
The EU has committed to making $750 billion in strategic purchases from the U.S. Think oil, LNG, nuclear technology during the rest of the current administration's term.
Wow, $750 billion.
Yeah, and a big driver for that is Europe's urgent need to phase out Russian energy sources. So there's a geopolitical angle there, too.
That makes sense.
Plus, European companies are expected to invest around $600 billion in the U.S. during this period. And though the amount wasn't specified, EU member states also committed to buying U.S. military equipment. That's an unspoken but pretty significant alignment.
So following the Japan deal, this EU agreement really kind of isolates China as the next big piece in that global trade puzzle, doesn't it?
It certainly positions China as the next critical negotiation, yeah.
Okay, speaking of big pieces, it's also peak Q2 earnings season. And the Magnificent Seven tech giants are absolutely front and center. You mentioned earlier the overall S&P 500 numbers sound broadly positive.
They do, yeah. Early results look pretty good.
But I've been hearing whispers that the Magnificent Seven might actually be telling a more nuanced story, maybe even one of divergence. What's happening beneath the surface with those big tech players?
It definitely gets interesting when you drill down. While the broader S&P 500 earnings growth improved to 6.4% year over year and revenues up 5.1%.
Pretty solid.
Yeah, and about 80% of companies beat expectations on both top and bottom lines, which is better than the 1, 5, and 10-year averages. So broadly positive.
Okay.
But the Magnificent Seven, they're not really moving as a monolithic block anymore. Take Tesla, for instance.
Right, what happened there?
Well, they're clearly seeing what looks like waning demand. Q2 vehicle deliveries were down 14%. That's the second straight quarterly decline.
Ouch.
Yeah, they missed expectations largely due to a 16% year-over-year drop in automotive revenue.
Yeah.
And part of that story is definitely the fierce competition they're facing from Chinese EV makers. Tesla stock reflects that it's down about 16% year to date.
Okay, so a clear negative story there.
Yeah.
And on the other side of that coin, how are the other giants faring? Any bright spots?
Oh, absolutely. Alphabet, Google's parent company, was a definite bright spot. They comfortably beat expectations on both revenue and earnings.
What drove that?
Largely robust performance from YouTube advertising and, significantly, Google Cloud. But what's maybe even more telling is Alphabet's capital expenditure outlook.
Their spending plans?
Exactly. They've increased their 2025 CapEx estimates twice already, Analyst expectations were around $58, $59 billion. They bumped it to $75 billion. Now it's up to $85 billion.
Wow, that's a huge increase.
It is. And the CFO expects further increases in 2026. This isn't just about normal growth. It's a clear signal of the intense AI arms race happening right now.
Right, building out that infrastructure.
Precisely. These tech giants are pouring billions into building out their AI capabilities and cloud infrastructure. It shows a long-term commitment that could really reshape the industry and create, new competitive moats. Alphabet's stock, by the way, is up about 2% year to date, so quite a contrast to Tesla.
Definitely a divergence. And we've got more coming this week, right?
We do. 4 more of the Magnificent Seven report this week. Meta and Microsoft are on Wednesday, then Apple and Amazon on Thursday. And NVIDIA, the chip giant that's really at the heart of the AI boom, they're due on August 27th. So lots more to watch.
So the performance of these tech behemoths is definitely a mixed bag right now. I've also heard about something called outlier earnings dates. Some analysts talk about date breaks factors. What does that actually mean for investors? Sounds like a subtle signal, but maybe an important one?
It absolutely is a subtle but potentially important signal. Yeah, date breaks factor is one term for it.
Okay.
What it means is that when a company deviates from its usual predictable schedule for reporting earnings, either delaying the report or maybe moving it up, it can actually be a powerful clue for investors.
How so?
Well, academic research suggests that, generally speaking, a delay often signals that negative news might be coming. Conversely, releasing earnings earlier than usual typically points to something positive the company is eager to share.
Interesting. So tracking those date changes could give you an edge. Any examples this week?
Yeah, looking at this week, companies like Regency Centers Corp, Booking Holdings, AES Corp, and CVS Health Corp, they're showing positive date breaks factors, suggesting potentially good news on the way.
Okay.
On the flip side, Teradyne Inc., PPG Industries, United Health Group, and Kimberly-Clark Corp have negative factors, hinting that maybe their reports might contain some less than stellar news. It's not foolproof, of course, but it's another data point for investors.
Right, another piece of the puzzle. Now, beyond the immediate earnings headlines and these date signals, for investors focused on building a resilient tech portfolio long-term, are there specific highly rated stocks that stand out right now? What are some of those quality assets you might be watching?
Yeah, absolutely. For long-term investors, focusing on quality is always key, especially in tech. When we talk about a Zacks #1 rank, that's Zacks Investment Research's highest buy recommendation. It indicates strong earnings momentum and potential for the stock to outperform. So 3 top-rated technology companies by market cap that currently hold that #1 rank are Shopify, SHOP, Arista Networks, ANET, and Amphenol, APH.
Okay, tell us a bit about Shopify.
Sure. Shopify, ticker SHOP, is that global commerce platform. It helps businesses of pretty much any size set up and run their online stores. Their dashboard's available in over 20 languages, lets merchants manage everything from marketing to payments to shipping, and gives them analytics. Their 2024 revenues were projected around $8.88 billion, split between subscription fees about 26.5%, and merchant solutions, things like payment processing, making up the other 73.5%. Plus, they have a huge app store with over 16,000 apps to extend functionality. It's a really powerful e-commerce ecosystem.
Okay, and the other two, Arista Networks.
Arista Networks, ANET. They're a leader in cloud networking solutions, primarily for large data centers and campus environments. Their key technology is this Linux-based Extensible Operating System, or EOS. It's known for being reliable and scalable. They also offer CloudVision for network-wide automation and monitoring. Their customers include 6 of the world's largest cloud service providers, so they're playing in the big leagues. 2024 revenues estimated around $7 billion.
And Amphenol. That name might be less familiar to some.
Right, Amphenol, APH, they're more behind the scenes but critical. They design and manufacture a huge range of electrical, electronic, and fiber optic connectors, as well as interconnect systems and cables. Think of them as providing the essential plumbing for the electronic world. They operate globally, manufacturing in over 30 countries, and serve diverse markets through segments like harsh environment solutions and communication solutions. Their 2024 net sales are projected at $15.2 billion. So they're often the hidden backbone supporting a lot of tech innovation.
Okay, fascinating stuff. So we've covered the Fed, U.S. jobs, the trade deals, the earnings season dynamics, quite a bit. But how do all these pieces connect to the broader global economy? What major macro data points should we be aware of beyond the U.S. this week?
Yeah, that's a key question that kind of emerges from all this, right? The interconnectedness.
Hmm.
We've definitely got some important international events. The Bank of Japan, the BOJ, meets on July 31st. Interestingly, that new U.S.-Japan trade deal we mentioned, it actually reduces some economic uncertainty for Japan.
Ah, so.
While less trade friction makes it more likely that Japan can finally hit its long elusive inflation target. As a result, economists are now expecting the BOJ to raise its key interest rate by at least 25 basis points before the end of the year.
Wow, that would be a big shift for Japan.
Huge. After years and years of ultra-loose policy, markets are actually pricing in a better than 50% chance of a move as soon as October. So that's definitely one to watch.
Okay, so Japan potentially normalizing rates.
Mm-hmm.
What's happening on the data front over in Europe?
Europe also has a really packed data calendar this week. We get the July flash inflation figures and the first estimate of second quarter GDP growth, both out on Wednesday.
And what's the expectation there?
Well, inflation did return to the ECB's 2.0% target back in June, but the consensus is that it's likely to fall from here, potentially dropping quite significantly early next year. So watching those inflation trends will be key for the ECB's path forward.
Right. And what about our neighbors to the north, Canada?
The Bank of Canada, the BOC, also has a decision on July 30th. They're widely expected to keep interest rates on hold at 2.75%.
Any particular reason?
Well, they're quite concerned about their domestic economy, particularly the jobless rate, which is up at 6.9%. And related to the trade discussion, they've also expressed worry that any retaliatory tariffs on U.S. goods could actually prove inflationary for the Canadian economy. So they're balancing domestic weakness against potential imported inflation from trade friction.
Okay. So with all this data flying around, central bank decisions, earnings reports,
Yeah.
volatility seems almost guaranteed, doesn't it?
It certainly feels like a week where things could get choppy.
It really makes you appreciate the complexity of, well, everything, global agreements, economic reports. So when the market inevitably gets rocky, maybe even this week, how do we avoid making those rash, emotional decisions? What does this all mean for the long-term investor just trying to navigate this kind of high-impact week?
That's the million-dollar question, right? The first thing to really internalize is that market volatility. While it definitely signals greater uncertainty, it also presents opportunities.
Okay.
Volatility is just the degree of variation in trading prices. It's actually a normal part of healthy, functioning markets. Now, in times of increased volatility, that bedrock principle of diversification becomes even more critical.
Spreading your risk.
Exactly. It's not just about spreading investments across different asset classes, sectors, or geographies. Maybe using something simple like an ETF, say the iShares S&P 500 ETF, ASX, IVV for Aussie listeners, or similar broad market ETFs elsewhere. But it's also about strategically rebalancing your portfolio to manage that risk exposure when markets get particularly choppy.
So don't put all your eggs in one basket, and maybe check the basket more often when things are shaky. What are some other practical strategies for our listener?
Another really crucial strategy is to stay liquid. That means maintaining a portion of your portfolio in cash or cash equivalents.
Why is that so important?
Because it gives you flexibility. It allows you to seize opportunities that might pop up during volatile periods, maybe buying quality assets when they're temporarily cheaper without being forced to sell other investments potentially at a loss just to raise cash.
Makes sense. Keep some powder dry.
Precisely. And always, always focus on quality. Invest in companies with strong fundamentals, things like consistent earnings growth, manageable debt levels, strong balance sheets. These types of companies often act as a buffer against volatility. They tend to be more resilient when markets get turbulent.
And when those market jitters inevitably hit, maybe your portfolio drops suddenly. How do we stop ourselves from making those emotional, impulsive decisions? Panic selling, for example.
Yeah, that's where disciplined investing really comes into play. First, do your homework. Thorough research to understand the reasons behind the volatility and their likely impact is essential. Don't just react to headlines.
Okay.
You might also consider using tools like stop-loss orders. These can automatically trigger a sale if a stock falls to a certain price you've predetermined, helping to limit potential losses without requiring you to make a snap decision in the heat of the moment.
A safety net, kinda.
Sort of, yeah.
Right.
But perhaps most importantly, avoid emotional trading. Seriously. Stick to your long-term investment plan. Resist those impulsive decisions driven purely by short-term market fluctuations or fear. Remember the old saying, time in the market beats timing the market?
Right.
True wealth generally isn't built by chasing headlines or reacting to every wiggle. It's built through patience, consistent effort, discipline, and smart diversification. Things like dollar cost averaging, investing a set amount regularly, regardless of market ups and downs, and reinvesting your dividends. These are the boring but powerful strategies that tend to work over the long haul.
That's a great reminder. So just to recap our deep dive today, we've really tried to cut through that huge amount of information surrounding this truly big week for global markets. Hopefully, you now have a clearer understanding of how all these things are converging, crucial economic reports, central bank decisions, peak earnings season, and the key takeaway seems to be having a strategic, disciplined approach to navigating the volatility that inevitably comes with it.
That's right. It's about understanding the signal from the noise, like we said at the start, and then applying those strategies, strategic diversification, maintaining some liquidity, focusing on quality companies, and staying disciplined. That should help you feel more prepared and confident, even in these dynamic, sometimes confusing market conditions.
So here's a final thought to leave you with as you navigate the days and weeks ahead. Given that market headlines will always fly thick and fast, what signal from the noise will you prioritize focusing on to truly understand and shape your own long-term financial journey? Think about that for yourself as you go forward.